Folks, we are going to talk to the one and only and great Lance Lambert from Fortune. And if you don't follow him on Twitter, News Lambert, you are truly missing out. He is housing, and somebody I look up to and respect. How you doing, buddy?
Doing great. Housing. Always a lot going on, and it feels like there's even more so lately.
Yeah. So I I have an opinion. Now I know you don't make calls. I know you're very data oriented and you're going to stay there and I respect you for it. But I have to share with you an opinion I have because it's frankly a little bit scary. Are you ready for it?
Hit me.
I believe the housing market is going to be broken for a decade. Initially, when I thought about this, I was thinking, maybe 5 years. But given what's going on today, what's going on in the economy, I really do think it might be a decade. And by broken, I mean we're going to have transactions below the past peak.
On the
So if you're
existing market.
existing home sales, correct,
Yeah.
correct. So I think that's what's coming. And I want to feel better than a broken decade, but I thought I would leave that to you. I thought maybe you'd ask me some questions.
And
You
so
maybe
you
guide
would
me
you
somewhere
would
else.
call the 80s a broken housing market,
No
correct?
question.
Yeah.
Absolutely. From
Using this.
1978 to 1996 is a broken housing market. 18 years to go. It took us 18 years for sales to get back to 1978's peak. So that is an example of 18 years. It's in my 53-year spreadsheet. I'm looking at that going, I think we'll do better than last time. We won't
Yeah.
have the double dip we had last time. But yeah, it might be a decade before we get back there.
Yeah, and Goldman Sachs call, which you brought up, is that existing home sales wouldn't get back to pre-pandemic levels ish until about 2027. And they're one of the people that thinks that the 10 year is going to stay elevated. Yes, inflation will come down, but it's not going to go under the target really for the next 3, 4 years. And so they think that affordability is going to stay pressurized because they still have prices moving up a little bit. So there wouldn't be a big affordability improvement. It would be like, kind of like this ish.
Exactly. Kind of like this.
And, a little bit of improvement over time because they have like low home price growth and they still have incomes rising. But that's not like a magic wand. That's not like the speed of the deterioration. The speed of home prices going up 40, 50% in 2 years, mortgage rates going from 3, 4, 5, 6, 7, and last week 7.5. That the deterioration happens much faster than the healing happens.
I agree.
And this was actually the fastest ever on the deterioration side. It was like like hitting a hammer on one of those games and just going up. We went from like kind of just around like the normalish affordability bar and smacked all the way to the top essentially.
We did. Yeah.
And it just takes time to come off of that. And you also need more supply on the new home side to give us a window where we can have incomes exceed home price growth and heal it. And that as that healing happens, plus people have life events, things happen, maybe mortgage rates come down a bit, that kind of gets some of that existing churn coming back into the market. But right now, we don't have the churn. It's just such a financial hit to go sell your home and to go buy something new. And one of the other things that some people are trying to do now is to get their wealth into a position where maybe they don't sell their current home because it's, they kind of see that mortgage rate, that low mortgage rate as an asset. So right now they're kind of like, you know what, I might be able to sell this home and buy something new, but it would be a real struggle. Instead, I'm going to hold this longer, get my income enough to where I could go buy a home and then keep this as a rental, which is also something that you've talked about over time. So it's a real process to get existing home sales moving up. And one other point is Goldman Sachs expects existing home sales to get back to pre-pandemic levels by 2027. That's not back to the peak.
No, that's true.
Getting back to the actual pandemic peak for existing housing market churn is going to be really far out.
Yeah, and that, just to clear, that is my call, right? To get back to the peak, it's going to be it'll be a decade because of everything you've just highlighted.
So what does that mean for people who make money on transactions? Is this a period where they're like in a period of false hope and they need to come to like realization and there's some churn out, especially some of the newbies? Or,
They need to
just a little bit of a lift here or a little bit
they
of mortgage rates coming in, give them some.
they there are going to be less people in the industries, right? We're in a real estate recession. One might argue depression, at least on transactions, right? Down 40%. And I think you've heard, I'm calling for August and September existing home sales to go below 4 million, possibly as low as 3.8 million. It's bad out there. I don't see us getting, much above 4.5 for maybe 2025.
Yeah.
So the answer is run your business like today's normal. Don't run your business like 2020 and 2021. That was not normal, right?
Yeah.
Also, if you're an agent, don't forget a lot of you have turned off on leasing. One of the things that agents did, and Graham Stephan did this when he got started, was he was basically a leasing agent. He was leasing space instead of selling homes, right? There are other ways you can make money and do all of these things, but yeah, I think if I really think we're not getting back for a decade, then this year is going to be very much like next year and the year after, and it just takes time for affordability to come in. If you're waiting for wages to grow, which they grow slowly, you let interest rates come in a whisker, because I don't think the Fed's cutting. It's time's the only answer, and that's where I think we're going.
Well, yeah. And if we're in a window where house prices and incomes are getting closer to normal, like a normal growth rate, then it's really going to slow it down even more. The only lever there that can move quickly is mortgage rates. And so it'll be, and that's also been the hope, is the people who live on transaction volume are like, hey, rates are coming in, rates are coming in.
Yeah.
It hasn't happened so far. So it'll be interesting to kind of see what rates look like in the next 12 months, though.
Yeah, I think the one thing that if you want to hang your hat on hope is, and again, you report this almost daily, so thank you for doing that, is the gap between the 10-year and the mortgage rate. It's called the spread. I think in your latest tweet yesterday, it just came under 300 basis points, like 297, something like that.
Yeah, we've only been under a 3 percentage point, 300 basis point spread like 4 days since like into April. So, and two of those just happened yesterday and today. So that's something, but we'll kind of have to see what it looks like next week and the week following, because it's kind of been a little sticky back to like that 307 type number where it kind of has went up and then kind of swings back. So let's see what happens there.
And the reason that's important, again, if you go back, historical averages is about 180, 185. So again, there's a natural gap there that can come in when the banks feel better. And again, I've told everybody there's a huge banking crisis, lending, deposits, expenses, all of that. They don't want to lend. So there's not really an incentive for that to come in. But sometime over the next decade, they're going to feel better, and that will revert to the mean, but probably not quickly.
Yeah. And then, the other thing is if a recession occurred, then that's a little bit of a game changer, and probably that comes in really fast. That is an interesting question of like, is the fastest way to heal this going through a downturn in terms of transaction volume? It's an interesting question.
Yeah, it's fun. Again, a lot of people hear this, they're going to say unemployment is the way to get the transactions. I would argue it would be higher unemployment for a long time. Because again, people today that have like the effective interest rate is 3.6% on all mortgages. For most people, that means your mortgage payment is less than rent.
Yeah.
So they're going to fight tooth and nail to keep that. They're going to stop paying the car, the phone, other things before and then they're going to have people move in. So again, a spike to 7.5% unemployment does not get inventory. A spike to 7.5% and a year.
I was talking less about getting like for sellers, and I was talking about it more of like, okay, recession occurs, but you keep your job, rates come down a bit. Is that, does that start to get some of the pent up move up buyers? And
no,
just because rates will be in enough.
No, because again, it depends on spread, right? People like the worst interest rate, in my opinion, is somewhere between 5.5% and 6%.
Mm,
That unlocks a gargantuan amount of pressurized demand. It
yeah.
does nothing to get
Well, yeah,
supply.
again, I'm not talking about inventory. I'm talking about existing home sales,
No, I
like keep
agree.
the number rolling
No,
up.
yeah. But so I think what we're saying, and maybe we're talking around the subject, is how do we unlock the move up buyer,
Yeah.
right?
Yeah.
How do they sell and then they buy?
Yeah.
To me, the worst number is 5.5 to 6 because it unlocks first time buyers and does nothing to unlock move up buyers.
Oh,
Rates
okay. Yeah.
rates probably have to go to 4.5 to get some of those people going, that's close enough. I hate
Yeah.
this house. It's too small.
Okay.
Uh,
I see what you're saying. So the people who make money on transactions are still in a tricky spot in the 5.5 to 6.5 because it's just really low volume still, but then it's appreciation. So it's the worst
exactly.
of what they don't want, which is appreciation on low transaction volume. Because if you're going to get the appreciation and you live in the industry, work in it, you want the volume there with it.
It's
Yeah.
volume based. Correct.
Yeah.
Yeah. So
Makes
yeah, I do
sense.
think 5.5, 5.7, 5.6 is the absolute worst interest rate. Because again, I care about the first time home buyers. I believe getting on the property ladder is the path to a better future. And like the charts you shared on video one, think about those markets, the entry level. If we had a 5.75 interest rate, no supplies coming,
Mhm.
demand what doubles 50%? It
Yeah.
blows my mind away.
Yeah, it's in it. Yeah, it'll yeah, and yeah, it'll be interesting to kind of see what happens the next 12, 24 months.
Yeah. And I know you're going to be reporting on it each and every day, each and every week, each and every month. Where can people find you?
On Twitter at News Lambert, where I'm sharing all the charts, all the data, and then you could also find my author page, Lance Lambert Fortune, in
Awesome.
Google.
Thank you so much. Follow him, guys. Follow him.